that I have really looked forward to talking with. I have heard his interviews several times on other podcasts, and every single time I hear him on Real Vision or with Grant Williams, I say, I have got to interview this guy. I've done several whiteboard presentations on his work as well. His name is Mike Green. Mike, welcome to the Rebel Capitalist Show.
George, it's a pleasure to be here.
Okay, so I just want to dive right. Actually, let's do a little bit of a background, maybe a minute or so, and let's go into your views on passive after that.
Sure. So I am the chief strategist and portfolio manager for a firm called Logica Capital Advisors. We run quantitative strategies in what's classified as a long volatility style. Our portfolios are built using exchange traded instruments to give exposure to markets both to the top side and the downside, with the idea being that we think the markets have become increasingly fragile in both directions. The past couple of days would be a great example of that.
Yeah.
And I've been in the industry in one form or another for about 30 years and have, worked for everyone from George Soros to Peter Thiel, and am now very focused on building institutional portfolios to take advantage of the dynamics that we're going to talk about with passive investing.
Yeah, so let's tackle that subject first. And I way oversimplified it. I probably didn't do it justice in a whiteboard video, but can you kind of go over your ideas and all the research that you've done and the potential problems that lie as more and more of the assets go into passive that doesn't have a decision-making process?
Yeah, well, so passive actually does have a decision-making process. It's just written in advance, right? We're going to, if you give us cash, we're going to buy, X proportion. We're going to put that money in to work in proportion to effectively the float-weighted market cap of the stocks that are in the index you're benchmarking to. So typically that would mean the Apples and the Microsofts and the Amazons of the world would occupy the vast majority of the allocations for people who are buying an S&P 500 type index fund. These strategies have exploded in popularity over the past 40, 50 years, right? So they were first introduced in 1975, initially at Wells Fargo, popularized by Vanguard. And the complaints against indexing have been around for just as long, right? Effectively, people saying, why would you want to settle for average? Why would you want to put yourself in a situation where markets are completely dependent upon a select group of individuals who are trying to set prices? The problem is that those complaints effectively didn't matter until a certain point, right? So there's a size at which passive becomes particularly relevant, and the understanding of that actually plays to making sure you understand what passive really is and how it impacts the market. And so the theories of passive investing received a huge shot in the arm in 1991 when a gentleman by the name of Bill Sharp wrote a paper called The Arithmetic of Active Management and made the very simple observation that passive investing was simply mimicking the behavior of all the active investors, the discretionary investors, and therefore it was going to have the exact same results as the active managers in total, and it charged lower fees. Therefore, investors on average would be better off with a passive investing style, right? So that was a very simple observation, very simple thought experiment that in many ways pushed the growth of passive quite aggressively through the 1990s and into the 2000s. If we look at the assumptions in that paper though, right, among the assumptions are that passive investors never transact. And that question was actually challenged in a 2018 paper by a guy by the name of Lasse Peterson. He observed that when indexes needed to rebalance, that they would be forced to transact. I looked at that work and said, oh my gosh, this is actually something totally different than he is thinking of, because the reality is flows mean that they are transacting every single day. So every single day, the Vanguards and BlackRocks of the world receive new inflows of capital. That means by definition that they have to transact in the markets. That means by definition, they can't be passive investors. Instead, what they are giant active investors that are actually setting prices. Yep. And so they're involved and impacting the market. It's all buying, and it's all buying in a manner that is price insensitive. They don't care about the valuations. They presume others have done that work. Unless markets are perfectly efficient, and that would include frictionless behavior, right? Which would mean that when you try to buy a stock, you have no impact on the price itself. You can't have these investors at this size, right? They are changing the market structure quite dramatically.
And what size are we talking about, Mike? I mean, I think it would be great for people to get their head around it. I mean, it's not just 100 billion, I say just, but I think you used a great example with Jim Simons and, his interview, and then taking that out and say, okay, well, if Jim's managing, I think it's 15 billion in his main fund, and BlackRock has 7 trillion, they
Yeah.
need to be thinking about this a lot more than Jim, and they're not.
Yeah, and I think that's ultimately, so they are very focused on the question of how do they get into the market with minimal tracking error versus a benchmark, right? And so that's a very different statement than saying having no impact whatsoever. When you represent the vast majority of the trading activity, you are by definition impacting that benchmark. You can try to minimize it, but you effectively are creating an accumulated stock problem, right? Where every single day you're buying a little bit, you're only influencing the markets a little bit every day, but that's a continuous pressure that's being applied, right? And a very simple example I can cite for people is if you look at the trading activity of Vanguard ETFs, for example, one way to think about price pressure or how you're influencing the markets is by tracking what fraction of the trades are occurring at what's called the bid or the ask, right? So if a trade happens at the bid, that means somebody's selling and being forced to sell at a level where they're meeting the nearest buyer. If something transacts at the ask, it means that they're transacting at a level that meets the nearest seller, right? They're effectively pushing the market higher. When I look at trading vehicles like the SPY, for example, or things that professional investors use, you'll often see that there's no meaningful pressure on either side, right? So the markets are up and down, trading at the bid and the ask on a somewhat continuous basis. When I look at many BlackRock products or many Vanguard products, they're continually trading at the ask with very, very high frequency, right? Effectively creating a lot of the upward pressure that we're experiencing.
Okay, so now walk us through what happens is more of the money, more of the assets go into passive and away from an active manager. So you're taking it away from someone who is making a decision based on, let's say, fundamentals, to an individual or an entity that is making the decisions based on, if I have a dollar come in, then I have to use that dollar to buy, regardless of price, regardless of fundamentals, regardless of what happens. And I think if my numbers are right, that at the beginning of the 2000s, there was about 10% of the assets in passive. Now there's about 50%. And as we get closer to 100%, what are the risks?
Well, you run into two separate issues, right? So the way that we model this is we think about it in terms of what's called an agent-based modeling system, right? So I create fake traders, right? Just little machines that effectively trade, and I give them the rules associated with the different types of trading activity, right? So a discretionary trader will consider valuations, for example. If a valuation is very high, they're less likely to buy. If valuations are very low, they're less likely to sell, right? You can contrast that with the very simple rules of passive, which is just, if you give me cash, then buy. If you ask for cash, then sell. Those are their very simple relationships. When the two try to trade, you're effectively populating a universe and allowing people to bump into each other to execute a trade, right? I want to buy, I want to sell, I need to find if somebody's there. As you introduce more and more passive traders, you effectively have the active traders bumping into agents that have no capacity to trade with them, right? And then they're forced to go find another agent that can trade with them. And so as passive becomes a larger and larger share of the universe, it becomes harder and harder to transact. It causes prices to move more violently in either direction, both to the top side and to the downside, depending on what the objective is. And this is exactly what we're seeing in the markets, right? It's actually changing the structure. The other thing that happens is because passive is constantly receiving inflows, they're constantly buying. And so as they find fewer and fewer parties to transact, that creates an inflationary dynamic on valuations. Valuations are forced to go up, which is again what we're seeing in the markets. And then the other thing that happens is passive investors are even more aggressive than that model would suggest, because not only do they have to buy and not really consider the price or the valuation that they are buying at, as long as it's a price that exists in the market, they're comfortable with it, but they also can't hold cash in the same way that an active manager or a discretionary manager can. And that has a very perverse impact. Most people haven't been through the math to understand this, but Your average discretionary manager, your average active manager is carrying somewhere in the neighborhood of 4.5 to 5% cash, right? They hold that for a variety of reasons. They have inflows and outflows, right? So they might not have purchased something yet that when they had an inflow. They might be preparing for outflows because they anticipate redemptions, and so they're holding some cash. They also hold cash because they don't want to have to sell something in order to buy something, right? So it creates option value for them in terms of deployment. Passive investors don't do that. They typically are carrying around 10 basis points in cash. Right? Now, those can be very large sums because of the size of many of these passive vehicles, but as a fraction of the assets that they're holding, it tends to be around 0.1%. 10 basis points is the way we'd refer to that in the industry. And so, ironically, the process of moving from that 5% cash level to that 10%, to 10 basis points or 0.1% cash level, that has a huge impact in the market. You would think
that would require that would happen, that would force to happen. Yeah.
Yeah. So, I mean, the short answer is, if you were to transition 100% of the market from active to passive with no change in flows, no money coming in or out of the market, that simple process would actually cause markets to go up 50-fold, 50 times, right? And it really is just a reflection of the fact that cash is neither created nor destroyed in a transaction process. If I buy from you, you receive my cash. If you sell to me, I receive your cash. The only way you can get cash from that 5% level to that 0.1% level is for prices to be forced upwards. So this is the crux of the issue that we're dealing with in the market today. Most of the models that people have historically done on the impact of passive considers it as a steady state dynamic. It's saying, well, at what level, if I run the market at 10% passive, if I run the market at 20% passive, if I run the market at 50% passive or 90% passive, what is the influence at that stable level? Almost none of the research that's been done considers the process of passive share growing, right? So money flowing into passive and out of active. And that's really where the difference lies and why we're seeing these impacts at a much lower level than most people thought.
Yeah, and so we're talking about the price just going up and up and up and up because they just have to buy, the passive investors or passive funds have to buy at any price. So the active managers will say, okay, well, if you're willing to pay this astronomical price, then fine, I'm just going to keep raising my price. And that happens more and more. But then what if we have, not just what if we have net outflows, but what if they just stop buying? So there's no more inflows. And I think you referenced this going back to March in your interview with Grant, that it wasn't necessarily that there was a net outflow of passive, that they just stopped buying, and then all of a sudden we have this huge volatility because of the distortion in the market that we're talking about, from the percentage being so high on passive and so low with people who are actually making decisions.
Yeah, so what happened in March is actually pretty straightforward, right? So if you think about passive, it's basically like a constant buying pressure that is exerted on the market, right? As money is taken out of people's paychecks, or as people save on a regular basis for retirement or pension plan contributions are made, et cetera, that money flows in a very stable and predictable, manner, right? And it's increasingly flowing into passive vehicles on that standpoint. You mentioned outflows. We actually are experiencing net outflows in part because of the aging of our population. Right. More money is being taken out. But the interesting feature is that older people are active investors. They tend to be invested with discretionary managers because they've stuck with their style for an extended period of time. Younger people, where the money is coming in, are almost exclusively passive, right? So money is coming into passive and it is leaving active. That's the broad picture of money going in and out of the system. Within the system, there are questions of how do active managers behave? Are they feeling particularly aggressive, or are they feeling particularly risk off, right, or defensive? And so what really happened going into March was, in the time period from September of 2019 until basically late February of 2020, we had experienced a dynamic where the professional investor, the discretionary investor, had been very concerned about a recession in 2020 tied to the inversion of the yield curve, which you've talked about, and other factors, right? As the Fed moved aggressively to address that in the third quarter and fourth quarter of 2019, those investors were forced to change their positioning and buy, right? So it created additional buying power. It caused shorts to be covered and caused the markets to melt up because there was nobody to sell to them except for other active managers, right? The passive players don't participate.
Was
As we
the
came in,
catalyst of that what the Fed did with the repo? When we had the
that
repo
contributed, that created additional buying power, restored buying power in particular amongst the discretionary community,
Okay.
right? But the underlying dynamic of that is when the coronavirus came around in January, February, and suddenly people recognized that it was a riskier environment. It wasn't that the passive vehicles sold, it's that the active managers sold and there was no additional buying power, right? So passive doesn't receive a signal that says, hey, buy more when prices fall, right? They're not saying things have become cheaper. It literally makes no difference whatsoever. And so they didn't respond. I mean, Vanguard came out with a fascinating statistic that less than half of their portfolios, less than half of their investors transacted in any meaningful way, right? They just didn't show up. They don't care. They're unaware that anything happened.
How is that different than normal, Mike? It's, as far as if that's a 50%, what would normal be?
So when you say at 50%, so just to emphasize, passive on our calculations in US markets, which is the furthest along in this fashion, we think they're between 43 and 44% passive at this point. That's an accelerating phenomenon, so it will probably be at 50 very quickly. But it's not quite at 50 yet, and that's actually quite important because 50 is a little bit of an inflection point. It effectively becomes the point at which more than half of the attempts to find somebody to trade with you are going to fail. Right. And so prices can become increasingly discontinuous under those conditions. Although for those watching markets today, it definitely looks in that very similar to that today, September 4th. And we're watching the NASDAQ crash. So.
Okay. So again, it's more volatility. So I think once someone wraps their head around that the markets will most likely become much more volatile, and that could be to the upside. It all depends on the flows into passive, which I guess would be hard to judge. I don't know if you've done a lot of work on that.
So we have ways that we track that. The simplest way to think about it is that, young people invest in passive. If you're employed and you're saving into a 401k, the chances are very high that your corporation or your employer has been forced to adopt passive instruments as the primary vehicles for your 401k. In fact, the single most popular vehicle for people to save in their 401ks and increasingly in their IRAs are things called target date funds that effectively capture all of your money and all of your assets into these passive vehicles and trade them in very predictable ways, right? So those are all areas that people will point to and they seem very safe and they seem, quote unquote, riskless, because of the simplicity of them and what they're incorporating in terms of a diversified portfolio. But they all have this underlying characteristic of these incredibly simple rules that say, if you give me cash, then buy. If you ask for cash, then sell. And that doesn't seem like a huge deal. It actually has very positive implications for markets as long as that money is coming in. But when money tries to get out of markets, they become non-participants and markets are forced to become increasingly volatile. And the really scary part, I look at the dynamics of Vanguard's statement that less than half of their portfolios transacted. What happens if 1% transacts?
Yeah, right.
What happens if 2% transacts? I mean, March was the single biggest crash that we've experienced, almost in the history of markets. The recovery has unquestionably been the single biggest recovery that we've seen in markets against an incredibly poor economic backdrop. We're seeing this fragility in both directions play out in markets, and nobody's transacted yet.
Yeah, meaning no one's been pulling their money out as far as those types of transactions?
In terms of those types of transactions, we are not seeing, the passive vehicles don't really have a mechanism for selling.
Right, right. And so I think if someone's able to get their head around this, and I mean, so many of my viewers and listeners comment all the time that they're in that position, Mike. They're the ones stuck with the 401k or the IRA or whatever, where their only options are to go into 1, 2, or 3, and that's pretty much it. And I think when a lot of my viewers hear what you're saying, they say, okay, well, the danger is that I'm invested in an ETF. So if I just, or an index fund. So if I just don't invest in that, then I'm going to be okay. But that's not necessarily the case, because what you're talking about impacts the entire market, whether you're invested in an index fund or you're just sitting there picking stocks yourself. Am I correct to assume that?
Yeah, I mean, a lot of people focus on ETFs. To me, ETFs are just a mechanism for accessing the markets, right? They have their problems and there are significant issues associated with them. But the much bigger issue is this general move towards indexation, right? Which means that everybody is transacting as frequently as possible in all the stocks, right? The single biggest mutual fund on the planet is something called the Vanguard Total Market Index. It's somewhere in the neighborhood of $1.7 trillion in assets at this point, carrying, by the way, about $5 billion in cash, which seems like an awful lot of cash until you realize, again, it's against $1.7 trillion, right? When you have that type of vehicle, it explains much of the behavior that we're seeing in the markets today, which is all the stocks are going up. The advanced decline lines are positive, right? They may not be, you're not seeing the dynamics of those stocks lead or outperform, but for the most part, you know, if you look at an advanced decline line on the New York Stock Exchange or on the NASDAQ or any of these, like everything is moving up together. Again, to me, that's a direct byproduct of this type of behavior. And it means that if you're trying to pick single stocks or you're trying to invest with other discretionary managers, you're going to be exposed to these same macro factors that we're describing here.
Yeah, exactly. So if the average person out there that's relatively sophisticated, let's say, if they kind of know what they're doing, what do, other than go, well, let's dive into that. So I guess the only answer is you got to be long volatility, because you don't know if that volatility is going to come on the upside or the downside. I mean, so many people think of volatility, they say, well, I'm just going to go ahead and short the market. But to your point, that short can go up 50 times if you get your timing wrong. So I guess my question would be, what would be the catalyst, the main catalyst to switch the volatility from having more tailwind to the upside to having more tailwind on the downside? And then what can three different groups do? Let's say a beginning investor, an intermediate, and then a professional, maybe an accredited investor, for going long volatility.
So we'll start at the bottom, right? Which is the starting out investor actually is in a really enviable position where the vast majority of volatility that they're going to experience in terms of their cash flow is on their labor side, right? So they have human capital, they're trading that in exchange for a salary. That salary is providing the vast majority of their income, and a small fraction of that is then going off to build wealth.
Right.
I'm not sure that I would change that much if I were that person, right? I would be cognizant of what's going on. I would be very cognizant of the lessons that are learned, but I would actually be using this time for education to prepare yourself for what happens when you actually really do start to have some assets. For the intermediate investor, I don't have a great solution, right? You've been pulled into a system that puts you into choice 1, 2, and 3, which effectively only have differences tied to your age for the most part. And I don't have a great solution for them. For the accredited investor, I think there's a number of opportunities to be long volatility. I think it's always dangerous to be long volatility simply for the purpose of being long volatility, right? So using the VIX instruments or the UX instruments, those don't actually directly capture the features that I'm talking about. We will almost certainly see volatility rise, but it's a very, very hard trade to do. So at Logica, we only work with institutions and accredited investors. Our minimum account sizes are quite large. But we ultimately are very focused on the idea of owning what we call as a straddle, right? Or what is called a straddle, which is a directional trade in markets where you try to make money in both directions. And the trick for us, where we focus our efforts, is in trying to reduce the cost of holding that positioning for our investors.
Right.
Right.
Okay.
So you pay like for that uncertainty.
Premium, so you're trying to reduce that premium.
We're trying to reduce the premium. That's exactly correct.
Okay. So now let's dive into the 60-40 discussion. I was just talking with a guy that runs quite a bit of money. I'm in St. Bart's right now. We were at dinner, and he was talking about someone that works for Dalio, I think, came out and was talking about how, ironically, the 60-40 portfolio is dead, because I think that was kind of their claim to fame. And so I know you talked about this, or you've talked about this in several of your recent interviews. So can you discuss the problems with that, especially in regards to bonds, the 10-year, and if by chance the 10-year were to go negative?
So in really simple terms, it's important to understand the components of a portfolio. So when we say 60-40, what we're saying is bonds and equities, right? Or equities and bonds, typically 60% equities, 40% bonds. Bridgewater's claim to developing what's called risk parity is actually to increase the bond portion of that portfolio, because the real value to bonds in a 60-40 portfolio has been the low volatility to the bond instrument, right? So if you think about a portfolio that is 60% equities, and average volatility in equities is around 60% or 16%, I'm sorry,
Okay.
and 40% in bonds, and the average volatility in bonds is around 1.5%, right? If you figure out what proportion of the volatility of that portfolio is tied to equities, it's just off the charts, right? It's basically a 100% equity portfolio. The bonds are a ballast in that portfolio, effectively providing you with a little bit of income associated with it, and effectively low variability that allows you to add to the equities at times that they've fallen in price and become relatively attractive, right? The innovation of Bridgewater was to say, look, you should actually increase the proportion that you own in bonds so that they represent a similar proportion of the total volatility. So instead of 60-40 portfolios, they would typically be running 60-40 portfolios, right? A levered portfolio, right? The problem with the fact that the income on bonds has fallen so low has two impacts to it. One is there's no more income associated with that. So effectively, you're just sitting with a cash portfolio for all intents and purposes. But also, because the interest rates have fallen so low, the volatility of those bond prices has increased, right? So their ability to go up and down a lot. And so it represents a larger and larger fraction. The last thing that has been important about that bond portfolio, and this has been a long-winded way to get to the question that you were asking me, is because the central banks, because the Federal Reserve has reacted to risk-off events where equity markets have fallen by lowering interest rates. That's been their response function. When they do that, when you lower interest rates, what you're actually doing is driving the price of bonds higher.
Right.
Right. And so what that has meant is that the correlation between bond returns and equity returns has been negative, which is fantastic from a hedging perspective. But you also have been getting positive returns from bonds. Right. So the problem is, if the returns on those bonds, the coupons or the yield to maturity goes negative, then while you have a hedging instrument, it no longer offers you a positive return. And that's the same thing as just owning a put on the S&P. And the efficacy of that put is increasingly uncertain as you approach that zero lower bound and the potential for interest rates to go negative. So it means that there's less hedges available to people. And if there are less hedges available and those hedges cost more money, then you need to reduce your risk allocations, right? And so this is the point that I make in the end game.
Is that
your portfolio becomes more volatile and lower risk, and so and lower return. I'm sorry. So more volatile, higher risk, lower return. In that scenario, you have to reduce your allocations. You have to reduce the size of that portfolio. That Bridgewater 60-40 portfolio, right, where it's 3 times levered, needs to be reduced back to a 60-40 portfolio. And the implications of that are that you have to reduce the demand for financial assets in total. Right, that's the concern that I have if we push those interest rates negative, that effectively, while we think what we're doing, what the Fed thinks it's doing by lowering interest rates is stimulating the economy and consumption, ironically, what they actually have done is stimulate demand for financial assets. And if that comes to an end, then you have a significant problem in the markets.
Right. So I'm thinking this through here. If rates go negative and that forces selling, wouldn't that increase the rates and get to some sort of equilibrium, or am I not seeing it right?
Well, what you would see is a selling of the negative policy rates, right? So you would see a steepening of the yield curve. You could potentially, depending on how committed the central bank indicated it was, you could potentially see actually longer dated bonds sell off on that event, right? And so that would be potentially quite bad for investor portfolios that are levered to those bond exposures. Right. And I think that's ultimately what people are talking about when they say this trade is largely over, right? The 40-year bond bull market that began in 1981, it's hard to see that it has much longer to go.
Okay. So next topic here, and I'm going to just maybe a couple more questions because I know we're short on time. The debt jubilee, I think that's something that kind of everyone's been talking about. And, what are our risks there? How do you see that playing out? Is that a reality? And if so, what are what are the risks that people aren't looking at?
Well, I think so. People tend to talk about debt jubilees in the context of, the Bank of Japan or high levels of sovereign debt, right?
Yeah.
Like that's, just be very clear, that's a bit of a fiction, right? Because when you have a fiat currency, you have a situation in which the government is effectively maintaining a fiction that it's borrowing, right? So the central bank is buying those bonds, et cetera. They're not really separate entities, they're the same, right? When you talk about a debt jubilee, therefore, it doesn't make any sense to talk about it from the standpoint of a sovereign entity. It only makes sense to talk about it from the standpoint of the private sector, right? And that can include municipals like state governments. It can include corporations. It can include households. And the problem with the policies that the central banks have promulgated and that they've used to try to stabilize the system to this point is that it's led to an increase in debt levels while the income has not risen in a proportionate manner to service that. Mm-hmm. And so that sets up conditions under which, under a diffuse, effectively, that debt is not equally distributed, the incomes are not equally distributed. You're setting up a condition in which an increasing fraction of the population can't afford to pay its debts. Right? And the only solution to that is to get rid of them in one form or another. Right? You either transfer a significant fraction of the income and then allow the servicing of those debts. And that would be quite unfair to those who have paid off their debts. Mm-hmm. Or you have to have some radically different setup, right? And that tends to be what a debt jubilee is. It tends to be an edict that comes from the government saying those who hold these assets, because remember, all debt is somebody else's asset,
right?
They need to take a haircut, right? And that's societally, that's a very difficult thing to do. It can only come from the top.
Do you think there's a way to do that through inflation?
No, I think it's the exact opposite. So the problem is that when people talk about inflation, they're talking about lowering people's purchasing power, effectively creating conditions under which those who have first access to capital, who can go to the bank and say, I can borrow a whole bunch of money, they can have those debts deflated away, right? But inflation is perceived as a solution to this problem. It's actually the exact opposite, right? All it does, inflation just concentrates wealth. And again, we've had a very difficult story because what we're taught about the 1960s and 1970s is that there was a tremendous inflation, and that inflation, was super bad, right? Mm-hmm. Well, that was actually a very different experience than almost anything we've had in history. That was an inflation that was largely driven by an outward shift in demand. You had an explosion in household formation. You had an explosion in people who were looking for work because women and minorities entered the labor force following the advances in civil rights in the 1960s. You had conditions that created a significant outward shift in aggregate demand, causing prices to rise. The central banks interpreted that inflation as bad and so tried to raise interest rates to prevent those prices from going up. But what that really did was it meant that the supply function, those who were building factories, et cetera, evaluated those choices and said, I'm not going to do this. I'm not going to build that additional factory. Right. So and because we've misinterpreted, what's that?
But constrict supply, which exacerbates the problem.
Exactly. That's what we did in the 1970s, right? The telling of these stories, when we tell them the wrong way, when we learn the wrong lessons from them, it becomes quite caustic to the policies going forward. And so we think of inflation now as being able to solve debts. That's not what it does. It means that the average household is not going to experience a wage increase that allows them to buy more food, shelter, health services, et cetera. They're going to be forced to buy less. And they'll typically be forced to actually find themselves with less and less assets as a result because their savings can't keep pace. It's not the solution.
Right, which just increases the inequality.
Correct.
Yeah. Okay. So last question here. I know a lot of my audience is really interested in gold, Bitcoin. So is that potentially a way to protect yourself from maybe a volatile future, or are those asset classes just as risky?
So I'm not going to comment in significant amount on Bitcoin. I think that to me, Bitcoin is not particularly interesting. I understand why others are interested in it. Gold has historically been one of the few assets where you can own an asset and it's nobody else's liability, right? So remember, a bond is your asset and a corporation's liability. A loan for a mortgage loan is your asset if you own it, and somebody else's liability. They have to make payments on their mortgage in order to do it. An equity is your asset and somebody else's liability. A corporation has to deliver results that allow them to pay the dividend or repurchase stock or have results that encourage other people to buy it. Gold requires no performance from anyone else, right? And so it's actually a quite interesting asset from that standpoint and has therefore unique characteristics in a portfolio. Bitcoin attempts to replicate that. I'm less convinced of it, right? So I think that gold plays an important part in portfolios. We include it in our portfolios at Logica, but it's not an answer for society, because if everybody takes their wealth and plows it into a unproductive asset, we all lose in aggregate, right? So it may be an individual protection, but it's very hard to believe that it's a solution for the societal problems that we're discussing.
Okay. So lastly, if you had to give one piece of advice to the person that's watching this that might have to be invested in stocks or bonds, I think the main thing is people are concerned about losing purchasing power if they're holding dry powder or holding cash, and they're like, what on earth do I do here? So with the exception of holding a little bit of gold, if they're looking at the markets, what's the takeaway that you would leave them with? And guys, you need to think about this. And it's not just, it's probably volatility, but is there anything else that you would suggest really honing in on to make better decisions for their financial future?
Well, I think the single biggest thing that I always encourage people to do is to invest in yourself, right? So making sure that you're educated and that you're informed. I can't give anyone specific portfolio advice. We obviously think that volatility, whether achieved directly or indirectly, should have a portion in a portfolio. We think it is underrepresented in portfolios. And so that's an opportunity for us professionally. But I would just encourage people to think of themselves as actually a corporation and to invest in R&D, to invest in human capital development, whether that's educating yourselves about the subjects we're talking about, whether that's becoming active in terms of defining your own political future, your ownership of your assets, how you've structured your balance sheet and your income statement, diversifying your sources of income away from purely income tied to a job into other forms of income, whether that's owning real estate, whether that's owning a productive business. Unfortunately, we're limiting the options for people to do that increasingly, but that would be my advice.
Okay, fantastic. Mike, we'll leave it there. For my viewers or listeners who want to find out more about what you do, where can they go?
You can go to www.logicafunds.com, and we have a research blog that has fairly technical work in terms of the materials that we've talked about. You can sign up for that. And as George mentioned, I'm fairly ubiquitous in the podcast universe these days.
And Twitter, but you got to remember that Mike doesn't use his picture. He uses the picture of that guy from the Princess Bride or whatever.
Yeah. So my Twitter handle is @ProfPlum99, ProfPlum 99, and I never intended to develop a Twitter following, but it seems to have happened, and it's too late to change now. So.
All right, Mike. Thank you again for your time, buddy. I can't wait to do it again.
Thank you, George. I appreciate it.